Investors have many options, including stocks, bonds, real estate, and alternatives like commodities, currencies, art, and other collectibles. If you're an expert in a particular industry, or maybe you want to do extensive research on a type of investment, you might enjoy buying and selling individual securities, like stocks. But if you want a hassle-free way to get a good return on your money, there's an easier way, called mutual funds. They do the hard work for you and offer loads of advantages. This podcast will review what a mutual fund is, the primary types of funds, their benefits, and how to purchase them. Hey everyone, welcome back. Thanks for joining me on episode 868 of the Money Girl podcast. I'm Laura Adams, an award-winning author, money speaker, founder of the Money Stack newsletter, and host of this show with over 43 million downloads. If you're getting value from the free content we love creating, do us a quick favor, submit a 5-star rating or review on Apple Podcasts, Spotify, or wherever you're listening. And as always, if you have a money question, a comment, please reach out. You can leave it on my voicemail line at 302-364-0308. You can also shoot me an email at lauradadams.com. And while you're there, you can sign up for the free Money Stack newsletter. Again, that's at lauradadams.com. So if you've been listening to the show for a while, I'm sure you're familiar with mutual funds, but we're going to kind of, dig into them on a little deeper level. So a mutual fund is a basket of investments. Think of it like a bucket that holds a bunch of things, and that's called the fund's portfolio. And so investors can buy this basket or this portfolio. Mutual funds are run by professional managers who pool funds from many investors to purchase securities like stocks and bonds and other things as well. But most mutual funds have many thousands of investors, and they hold hundreds of millions or even billions of dollars that they then go out and invest. So each share of a mutual fund represents ownership in the fund and the income that it generates. And buying shares in one or more mutual funds is a really easy way to purchase things like stocks, bonds, or other assets. So let's talk about the primary benefits of investing in mutual funds. They are extremely popular because they give investors some really nice benefits. We'll go through 4 of them. The first is what I previously mentioned is having professional management. So many mutual funds are actively run. Now, not all of them are. I'll talk more about that in a moment. But those that are actively managed are run by managers who research what the fund will buy and sell, and they closely monitor the fund's performance. The managers buy securities in large quantities, and they have to abide by the fund's stated objectives and investing rules. So, they've got pretty strict guidelines on what they're trying to accomplish for investors, and, they stay within those guidelines. Therefore, when you buy a mutual fund or a mutual fund share, you also buy the knowledge and the experience of the people who are managing that fund. Researching and picking individual investments on your own is a task that most people do not have the time, interest, or skill to do. So when you think about it, having that professional management, is something that's worth quite a lot. The second major benefit of buying mutual funds is getting diversification. Since most mutual funds invest in dozens or even hundreds of securities, they give you instant diversification, and that is a significant benefit. If you pick individual stocks on your own and one of them takes a dive, the price just plummets, you could lose a substantial amount of money. However, diversifying or spreading your money across many securities in a mutual fund reduces risk without sacrificing potential return. One poor performing security in a mutual fund gets smoothed out by others that maybe maintain their value or even go up, depending on what's happening in the economy or what's happening in that industry. Mutual funds can give you exposure to many asset classes like large and small companies, those that pay dividends, a lot of different industries and companies in developed or emerging market countries. And you can be diversified among corporate, government, and international securities like with bonds. Owning various assets and asset classes means they would not likely move in lockstep to economic changes. For instance, if you only invest in technology stocks, you have a high risk that bad news in that sector would cause your portfolio to plummet. So diversification is something you'll hear me talk a lot about on the podcast because it's just a fundamental part of investing safely. The third benefit of mutual funds is keeping costs low. While buying and selling hundreds of assets, like stocks, as an individual investor would be expensive due to sales commissions, mutual funds aren't without fees. But I will say I think they're much lower relative to trying to replicate the ownership of a mutual fund on your own. Mutual funds have to be compensated for their expertise and convenience, after all. But remember that the more you pay in investment fees, the lower your returns. So you want to carefully compare funds' expense ratios, which are expressed as a percentage. The expense ratio is what the fund charges to cover its operating expenses, like administration and marketing. Also, you want to look for loads, which are another word for a one-time sales commission that you have to pay when you buy certain mutual funds. However, there are also no-load funds that don't have a commission. And the fourth main benefit of mutual funds is getting automatic reinvestment of earnings. Dividends paid by stocks, interest from bonds, and capital gains earned by selling securities in a mutual fund's portfolio can be automatically reinvested for you in the form of additional shares. So getting professional management, diversification, keeping low costs, and getting automatic reinvestment of earnings are all great reasons to own funds. So let's talk about the different types of funds. There are really four main types of funds that you should be familiar with and that we'll cover here. There are many more than just four types, but we'll cover the four main ones here. The first is what I previously mentioned, which is an actively managed fund. So these employ professional managers who choose from among thousands of securities and buy and sell them to deliver the best possible results for investors. As I mentioned, they research companies and try to determine which ones will be successful based on their industry, the products that they sell, their sales numbers, their profits and competition, among other types of factors. The second type of fund is very different. It's called index funds. These funds track indexes or broad baskets of different securities. They're not actively managed by experts who are trying to beat the market, and so they typically have lower costs compared to an actively managed fund. Instead, an index fund aims to match a market, like the Standard & Poor's 500, which is a stock index. Many index funds are designed to mimic the S&P 500, which measures the performance of 500 large U.S. companies. And over long periods, the S&P 500 has returned nearly 11% per year on average. That's why it's such a popular index that funds want to mimic and, want to get those returns if they can. So there are index funds that mimic other benchmarks, like stocks of small U.S. companies, different types of foreign stocks, the foreign and domestic bond markets, and industries, specifically like energy and healthcare. But in general, when you hear somebody talking about an index fund, they're likely talking about one that is looking to mimic the S&P 500. The third type of fund is an exchange-traded fund. So an exchange-traded fund, or ETF, are not technically mutual funds. They're a mashup of an index fund and a stock, if you want to kind of think about it that way. Like index funds, ETFs hold baskets of securities that follow indexes. Unlike mutual funds, which get priced just one time a day at the end of each trading day, ETFs trade like stocks because you can buy them and sell them throughout the day. So that's what I mean. They're like a mashup of a stock because of the way they trade, but more like an index fund in the fact that they are a basket of securities. And because you can buy as little as a single share of an ETF, the minimum investment for owning an ETF is typically less than for a mutual fund. Ongoing ETF fees are low, and some investment companies and brokerages offer a selection of commission-free ETFs. Given that most actively managed funds do not beat the market over the long term, the popularity of index funds and ETFs has skyrocketed. And the fourth type of fund we'll talk about is a target date fund. So these have a name that includes the year closest to when you expect to retire. For example, let's say you're 40 in 2024 and you plan to retire around the year 2050. You would choose a target date fund that has the year 2050 in its name, or a year that's as close as possible to the time when you want to retire. And target date funds own various securities that change in allocation over time. As the fund approaches the target date, it becomes more conservative, lowering the percentage of stocks in favor of more bonds and cash. So that reduces the fund's volatility as the target date approaches, helping to reduce the likelihood of significant losses as you near the year you plan to retire. To buy any of the funds that we've been talking about, you need to either have a brokerage account, which is a taxable account, or a tax-advantaged retirement account open in your name. And they'll give you an investment menu to choose from. And, many people will look at a fund's past performance when they're trying to decide what they want to buy. Remember that a great one-year record says very little about likely future results of a fund. So good long-term results, like maybe at least the last 10 years, is something that you want to look at. That can indicate if an actively managed fund is well managed. But with passively managed index funds and ETFs, you want to review how much the fund charges, known as its expense ratio, when you're comparing different potential investments. The most important decision you can make as an investor actually isn't which fund to buy, but what's essential is your asset allocation, or how much you own of different asset classes like stock funds and bond funds. So, if you have an index fund that is mimicking the S&P 500, those are all stocks. So if that's all you own, you would have 100% of your portfolio in stocks. Stocks are more volatile, but they have higher returns. And bonds are less volatile, but have lower returns. For example, since 1926, stocks of large U.S. companies have returned about 10% per year on average, while bonds have returned a little more than 6%. And the average investor will have a mix of those. Remember that a well-diversified portfolio gives you a good return with less risk. So when you're choosing investments, another critical factor is your time horizon, or when you plan to start spending the money that you're investing. That should determine your level of acceptable risk. In the short term, stocks can be volatile, but over decades, they are less risky. If you're in your 20s and 30s and you're investing for retirement that's likely to be in your 60s, you can justify investing virtually all or most of your retirement in stock or index funds. But as you approach and enter retirement, you should invest more cautiously to preserve the wealth that you've worked so hard to build. That means owning less stock funds and perhaps more bond funds, money market funds, and other cash savings like CDs as you get closer to retirement or enter retirement. It's really easy to buy all of the funds that we've talked about. You can certainly work with a financial planner who will help you choose funds, or you can use a brokerage that will have an extensive menu of fund options. I'm a really big fan of robo-advisors that offer well-diversified investment options. They also give you features like automatic portfolio rebalancing and more features with really low management fees. Plus, they typically give you access to a human advisor if needed. So whether you're just getting started investing or you need to really reevaluate what's in your portfolio, there is a huge place for funds like mutual funds, index funds, target date funds, etc. They can give you a lot of diversification and convenience with very low fees. Before we go, a quick reminder to subscribe to The Money Stack. That's my weekly newsletter when you visit lauradadams.com. It's filled with money tips, tools, news, challenges, and things I enjoy. You can subscribe for free or support the show as a paid member with access to live educational events. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our amazing team. Steve Rickyberg audio engineers the show. Brandon Gachus is our director of podcasts. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. And Davina Tomlin is our marketing and publicity associate.